This conference will now be recorded.
All right. So today we're going to talk about insurance basics and terminology. So again, I always leave room for Q&A. We've got a small group here, so if you do have a question, just chime on in. If you need a little more clarification on any of the topics, all right? But yeah, let's kind of just dive right on in here. Insurance. Two parts here. Number one, you're going to get a question on the definition of insurance. You probably will get two. Right? One of them will be that it's a contract of indemnity. I've seen it where it's a one-word answer. Insurance is defined as which of the following, and the answer is contract. That's the best answer to pick. Not very definitive, but this is what the test throws at you. It's a contract to indemnify you because you suffered a loss from an uncertain or unknown event. I mean, that's kind of keeping it simple. The technical definition is insurance is a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. That one you might get also. So again, you will get a question on the definition of insurance. I just don't know what it may look like because there's so many ways of saying it. And they might flip it. You know, a contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event would be known as which of the following. And then you just want to pick insurance as the answer on that. All right. So it's a contract, whereas most agreements, the contracts don't have to be in writing. Insurance contracts have to be in writing. It is a contract to indemnify you. Indemnification means to restore you to what you had before a loss, or restore you to the condition that existed prior to a loss. You see, so there's different ways of saying the same thing. The test goes a little crazy with the thesaurus. So kind of be familiar with the concept. Now, it's a contract to indemnify you because you suffered a loss from an uncertain or unknown event. In insurance, the loss must be uncertain. If it's a certain loss, your insurance companies will not issue a policy. So if you have a house up in the hills and there's a brush fire heading towards your house, you cannot increase your coverage and you cannot buy a policy if you didn't have one, because that's a certain loss. The fire is already on the way. Okay. I mean, I don't know of any insurance company that would jump into a contract knowing full well they're going to have to eventually pay a claim pretty quickly here and lose money. And so the loss must be uncertain. Now, that's the definition. The concept of insurance is transferring risk from a large group, actually, I say from a small group, those who suffer losses, to a large group, everyone purchasing the policy. So it's kind of law of averages. Right? I mean, not everyone's going to have their house burned down. Statistically, from what I saw, I think out of 100 homeowners, I mean, one may actually have a fire, but 17 will die before the mortgage is paid off. And so, you know, few people suffer losses, but everyone's paying into the pool to provide funds to cover those losses. That's kind of what that is. It's risk transference from a small group, those that suffer losses, to the large group, everyone buying the insurance. Indemnity, we kind of talked about, is to restore you to the condition that you had prior to a loss, to make you whole again. So if there's a 3-bedroom, 2-bath house before the fire, you know, then with the insurance, we'll rebuild the exact same 3-bedroom, 2-bath house it was after the fire. No more, typically no less, right? So if it's a 3-bedroom, 2-bath house, we're not going to build you a 5-bedroom, 3.5-bath house. That kind of improved your condition. That's a gain. And with insurance and indemnity, it's there to cover the loss, to put you back where you were before the loss, not to give you a gain. Right? In order to buy insurance, you have to have insurable interest. Insurable interest is basically defined as having a legitimate economic or financial interest in the preservation of the life of the property that is the subject of the insurance. That's the technical definition. That's a lot. Keep it simple. In order for you to buy a policy on someone or something, if that someone or something suffered a loss, there's a financial effect for you. Now, the test may say an economic effect. Okay. That means financially you're affected. So you can insure your house, because if your house were to burn down, it will cost you money to fix it or rebuild it. But you couldn't insure your neighbor's house. If your neighbor's house burnt down, emotionally that'd be, you'd feel for them. That's too bad. But financially, there's no effect for you. You see? And so since there's no financial effect or financial interest, then there's no insurable interest, and you cannot legally take a contract out on that property. And that's how you want to understand that portion. Now, you do have to prove insurable interest twice in the property and casualty world. Number one, when you purchase the insurance, and number two, at the time of the loss. Now, when I say when you purchase insurance, the test may say when the insurance goes into effect or on the date of application. Right? Again, there's multiple ways of saying the same thing. You need to prove insurable interest when you buy the insurance, and you have to prove insurable interest at the time of a loss to collect. That's the property and casualty world. In the life and health world, you only have to prove insurable interest once, date of application, or when the insurance goes into effect. Afterwards, really doesn't matter in the life and health world. Okay. You need to know the definition of the word person. Person on this exam is basically any legal entity. That's person, association, organization, partnership, business, trust, corporation, or limited liability company. Any one of those is a person. So the test will say an insurance agent is a person. That means an insurance agent could be a partnership, or an insurance agent could be a corporation. That's what they mean when they say that. A natural person is an individual human being, just like you or I. So a natural person is a person, but a person is not necessarily a natural person. It sounds confusing, but think of it this way. Poodles are dogs, but not all dogs are poodles. Okay? So a natural person is a subcategory of the word person. Now, on your exam, typically you want to associate natural person with the licensee known as an insurance solicitor. Whereas an agent or broker is a person, which could be a partnership or LLC, an insurance solicitor must be an individual human being. And they represent a property and casualty broker agent in transacting property and casualty coverage. That's kind of what that's about. So that's going to be some key words that every once in a while you will get. And when you go through my playbook, my online playbook, there are keywords in there that'll help you associate and get the right answer. All right. Law of large numbers. All right. So the larger the number of similar risks that are combined into a group, the more predictable will the insurance company's future expected losses be. So by measuring the past, you can predict the future. Now, I've got some other items here. Mortality is basically what's the likelihood of you dying. And that's used in the life insurance world. Insurance companies have tracked millions of people's lives over a long period of time to get some predictability as far as what's the likelihood of you dying based on your age and sex. And so they've created these mortality tables. The current one, out of 1,000 male babies that are born, one is expected to die. Okay, we don't know which one because under the law of large numbers, you cannot predict individual loss. You can only predict expected losses in a group, right, based on past experience. So you measure the past, you predict the future, but you can only predict expected losses in a group. You cannot predict individual loss. Now, out of 2,000 female babies that are born, one is expected to die at birth. Okay, that's statistically what's going on, right? But that's mortality. Now, for the health insurance world, we use morbidity tables. What's the likelihood of you becoming sick, injured, or disabled? But again, you measure the past to predict the future. Now, under the law of large numbers, the exam goes crazy with some language that says we're going to track a large number of homogeneous exposure units. Okay, it sounds like milk. Homogeneous exposure units. Right. So again, we're tracking like several homeowners in a certain area over a long period of time to get some predictability as far as what's the likelihood of a loss occurring in the future. And so I'm in Northern California, and in San Francisco County, on average, there's probably 2 fires a day. On average, no more than 1/3 of the property is destroyed. So it doesn't mean that, every day there are 2 small fires in that city, or in that county, I should say. But, here we have a week where nothing happens, and then one day 20 homes burn to the ground, But if we average it out over a period of time, it equates to 2 small fires every day. And so insurance companies who want to insure property in this area, they need to collect enough premium to cover those losses during that period. And that's what the law of large numbers is all about. Risk. Whenever you see the word risk, look for the key word. It's basically uncertainty. Risk is the uncertainty of a loss. All right. Your house may burn down. It may not. You may get into an auto accident. You may not. All right. So it's uncertain that a loss may occur. That's what the risk definition is about. Now, there's 2 types of risk you want to be familiar with. You have speculative risk and you have pure risk. Speculative risk, think of gambling. When you go gambling, you could win money, you could lose money, you could break even. So there's a possibility of loss or gain or even breaking even. That's speculative risk. And that's a type of risk that we don't insure. Remember, insurance is a contract of indemnity. That means it's to restore you to what you had, but there's no gain. So in speculative risk, you can get a gain. And if there's that possibility, the insurance companies will not write it. Right? Or they'll limit what's paid at the time of a loss. Okay, so that's speculative risk. Pure risk is the possibility of loss only. And that's the type of risk that we can insure. So you cannot insure the outcome of a sporting event. You cannot insure the outcome of the lottery. But you can insure the liability at a sporting event because someone could suffer a loss. That's how you want to understand that part. Okay? Some more definitions. Methods of risk management. Now I have STAR, STARR. That's probably the best way to understand that. Sharing, transferring, avoidance, reduction, and retention. But in the real world, we really use just the bottom 4, TARR. I'm going to start at the bottom. A lot of times when I'm talking to people about insurance, I'm always fishing for additional coverages. Kind of like at a restaurant, right? Usually you tip a percentage of the bill. So with the larger bill, right, they typically tip more. So you want to do the add-ons. Hey, did you save some room for that apple pie? Or, whatever. And so with insurance, you want to do these add-ons also. And so when I'm sitting with a prospect, I'll say silly things like, hey, do you have any target items? And some people say, what is that? Stuff you buy at Target? And no. But, a lot of women, they have jewelry. And a lot of women, they keep the jewelry in a little, in that pause, in that little, what do they call that thing? And they'll chime in, it's a jewelry box. Okay. Now that jewelry box is usually sitting on the, what do you call that thing? And they'll say dresser or armoire. Okay. Or vanity, I should say. Okay. Yeah. And in which room of the house is it in? And they say, oh, it's in the bedroom. Okay. So if a jeweler breaks in, where would they target? The jewelry box, on the dresser, in the master bedroom. Now, with your particular homeowner's policy, if someone breaks in and steals all your jewelry, this policy is only going to give you $1,500 worth of replacement for that jewelry. Now, you see, that jewelry is a target. So is $1,500 enough to replace all your jewelry? And if they say no, then I'll say, well, would you be interested in adding on some jewelry coverage? And when they say yes, they're saying, yes, Lauren, please charge me higher premium. Okay? Because if they don't have to buy the jewelry coverage, but you do want to make them aware of it. And so if they don't buy it, that's what we call retention. Retention is they're not buying the insurance to protect the loss. You're retaining it. You're paying for it out of your pocket. The only time you really want to retain risk is, number one, the worst case scenario is known. That means the maximum amount of money it would cost you is known. That's number one. Number two, you can afford it. Okay? So if you have $80,000 worth of jewelry, okay, so the maximum amount of risk is known, right? And you still don't want to buy the jewelry coverage, okay, then I'm going to ask you, well, if someone does break in and steal your $80,000 worth of jewelry, can you afford that? Okay, and if they say yes, okay, great, then you can self-insure that. And that's what retention is. Don't buy insurance. But a more subtle way of retaining risk is raise your deductible. By raising your deductible, if a loss occurs, you have to pay more of the smaller claims rather than burden the insurance company with that. And since you're taking on all the smaller losses, the insurance company doesn't have to deal with it. And so there's less admin costs and expenses associated with that, and they pass on the premium savings back to the customer. All right, so raising your deductible lowers your premium. You want a lower deductible? Great, you pay higher premium. All right, so, but that's retention. Reduction of risk, right? Rather than keep your jewelry in a jewelry box on the dresser in the master bedroom, put it somewhere else, like a safe deposit box. I mean, it could still get stolen, but it's less likely because it's in a pretty secure location, a safe deposit box in a bank. Okay, you can go a different route. You know, maybe put it in the butt of a turkey in the freezer where a burglar typically wouldn't look. You see, so you're reducing the likelihood of a loss occurring, such as that. You could avoid the risk, just sell all your jewelry so there's nothing to steal. That's avoidance. All right. Or you can transfer the risk by paying the slightly higher premium to have the insurance company replace your jewelry in the event that it is stolen. You see, so you have options. Now I'm in California, and in California, when you sell property insurance, you have to offer earthquake. Well, they don't have to take it, but you have to offer it. All right. Now a lot of people say, well, it's expensive and it doesn't cover much. Got it. Okay. Although it's expensive, doesn't cover much. What's going to happen if you don't have it? Okay, that means if an earthquake destroys your house, you have to rebuild it out of your pocket, plus replace all of your belongings out of pocket, plus cover the cost of a hotel till you rebuild that house. You see what I mean? And so, knowing what the premium is to have your house rebuilt versus you got to cover it out of pocket. Okay, so I mean, this is something you want to present to your prospect. So if they don't buy it, they can retain the risk. They didn't buy the earthquake coverage. They can reduce the risk by retrofitting their house so it stands up in an earthquake. You can avoid risk by selling your house and moving to some other area where there are no fault lines and typically no earthquakes occur. Or you can transfer the risk by paying the premium and having the earthquake program cover the cost to rebuild your house. Right? And so again, you want to educate your clients like that, and on the test, keep those concepts in mind. Now, sharing is just an indirect transfer of risk. So there's two areas where we can share at the bottom of the chart here. You have reinsurance, which most people don't even see. All right? And then you have co-insurance, where at the time of a loss. So reinsurance is when the policy goes into effect. Co-insurance is typically at the time of a loss. So reinsurance, all right, every insurance company that's approved to sell, let's say homeowners, I'll use that right now. Every insurance company that's approved to sell homeowners in the state of California has to provide the Department of Insurance with their financial statements. Based on that company's surplus and reserves, Department of Insurance says this is your retention limit. The retention limit is the maximum amount of risk that a company may assume per any one policy. So let's say there's one company in registering with the Department of Insurance to get a certificate of authority to sell in the state. Department of Insurance gives them a retention limit of $1 million. That means this insurance company can write up to $1 million worth of coverage for anybody they meet. They can write as many of them as they want, but they cannot handle more than $1 million per policy on their own. So if a customer comes in and says, I need $3 million worth of coverage, this company can actually write 3 $1 million policies, right? Because that's the $3 million worth of coverage, and it stays within the $1 million per policy maximum that they can handle. But the customer will say, well, wait a minute, 3 policies, that's 3 policy fees, 3 admin charges. That's not really cost effective for me. So this insurance company says, well, I don't want to lose your business. So they're going to go ahead and write the $3 million face amount on the policy. They're going to assume $1 million, and then they're going to find 2 other companies, and I'm going to use an example, 2 other companies to pick up $1 million each. So you basically have 3 companies financially backing this policy, each with $1 million worth of money at risk. Okay. Now, the first insurance company that you bought the policy from is called the Ceding Insurance Company, CEDING, also called the primary insurance company or primary carrier that's dealing with a client. This customer buying this $3 million policy from this primary insurer has no clue that behind the scenes, they've actually shared $2 million of risk with 2 other companies. All they know is they bought the $3 million policy with that first company, and that's it. See? So clients never see this part. But this is one way of an insurance company's reducing their liability exposure, right? When someone wants a high amount of coverage and, they can't handle it by themselves. It's above and beyond their retention limit. And so they're sharing the risk with other companies. That's what reinsurance is about. And this goes on all the time. Co-insurance is at the time of a claim. Insurance companies encourage you to carry adequate amounts of coverage. And for the exam, in most cases, they use 80%. It can be 70% or 90%, whatever, in the real world. In some states, they do use different numbers, but most states use 80%. So if you have a $100,000 building, your insurance company encourages you to carry at least 80% of coverage to the value of that $100,000 building. That means they want you to carry at least $80,000 worth of coverage on this $100,000 building. All right. And if you do that, the insurance company gives you some additional coverages for free called extensions. And that's in the property coverage, commercial property coverage. If you do not insure at that 80% requirement, you insure for less than that. The penalty is you actually have to pay more at the time of a loss. So you got to get the Coinsurance Equation down. It is on my website. So when you're studying in my material, the Coinsurance is one of the webinars at the bottom, but I do have quite a few questions on it. Namely, exam 2, question 118. I've got 4 of them back to back, 118 A, B, C, and D. At best, I got to be honest with you folks, you may get 2 to 3 math questions. So you didn't fail the test because you didn't know math, right? So there's other areas to focus on. So don't get, I'm lousy at math, let it go, man. If you go through my material, the numbers on my exams, when you take your test, will look familiar to you because it's kind of pulled from the exam, okay? You do need to know the Coinsurance Equation, and that's in the playbook. I simplify it to how much insurance you did have divided by the amount of insurance you should have based on the insurance company's coinsurance requirement. You take that, what you did divided by what you should have had times the loss, and that's how much your insurance company will pay on your claim minus any deductible. And the exam will give you the deductible for those questions. But to run through it so you're a little comfortable and get that Coinsurance Equation down pat. All right. Peril. You got to know this one. You'll get this 2 or 3 times. A peril is defined as which of the following? It's a cause of a loss. Right? Or a cause of a loss would be known or better known as which of the following? Peril. All right. So with my questions on my website, I always tell you read the question and read the right answer, and then read the right answer and then read the question. So, my question, this is the question, this is the answer, but when you take the test, they might flip it where the answer is now the question is now the answer. But a peril is defined as cause of a loss. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause loss. Right? So then we have causal loss forms. And the causal loss forms are basically, basic, broad, special, earthquake. and a BOP standard form. But it's broken down into two general classifications: named peril forms, like basic, broad, and commercial property earthquake, and a BOP standard form. Those are all named peril forms. And then we have all risk or open peril or special form. Those are interchangeable. And now these forms are the opposites of each other. A named peril form lists perils that the policy will provide coverage for. So a standard fire policy covers three perils: fire, lightning, and removal. So if you suffer a loss that is not one of those three perils, it's not going to be covered. Right? That's a very limited policy. Right? Now, an all-risk form like an HO5, which is kind of the top-notch flagship type of homeowner's policy, it's a special form. And when you see all risk, open peril, or special form, you'll notice it has a list of exclusions. It has a list of perils that the policy will not cover. So if you suffer a loss and it's not one of the perils on this list of being excluded, then it's covered. So the named peril forms and the all risk forms are actually opposites of each other. The named peril has a list of perils it covers, and the all risk has a list of perils it excludes. Right? So make sure you understand the difference. Go through the material. You will get quite a few questions on perils. And this is more for your property coverages. A hazard is a condition that would increase the likelihood of a peril or a loss occurring. Right? So having badly worn tires on your car, that would be a hazard. Right? Because with badly worn tires in that first rain, you're trying to stop, right? But because of badly worn tires, you hydroplane and have an accident. And so the accident is the peril. That's the cause of a loss. The badly worn tires are the catalyst that led towards that accident. And that's what a hazard is. Right? It's like a catalyst to a peril. It increases the likelihood of a peril or a loss occurring. The badly worn tires I've described is called a physical hazard, something structural, something tangible. Another example on your test would be living next to an explosives factory would be an example of which of the following. And again, that's a physical hazard. It's something you could reach out and touch. There's other types of hazards. These next two, make sure you know the difference. Moral versus morale. A moral hazard, it ends in the letter L, right? And that's where someone has a tendency to lie, cheat, be dishonest, okay? And that basically increases the likelihood of a loss occurring because they're lying about it, okay? Or they might malinger after a claim. Like maybe they suffer a workers' comp or disability claim and they malinger. What that means is they drag their feet in getting healthy and getting back to work because they're making the same amount of money just sitting at home on the disability playing PlayStation. Okay, that's a moral hazard. A morale hazard ends with ALE. Think of more ale. When you drink more beer, you get careless and clumsy. You got that liquid confidence, and you take more risks. The test will define that as having an indifferent attitude. That's a morale hazard. Okay, more ale. Someone who drives fast, they participate in high-risk hobbies, they just don't care. That's a morale hazard. Again, they're more likely to suffer losses. That's a factor. Legal hazards are people that are going for more money than they're legally entitled to. All right. Someone in stop-and-go traffic gets bumped. They clutch the back of their neck, they open the door, and they fall to the ground. Now they're going to sue you for $2 million claiming soft tissue damage, which is pretty subjective. Now, the insurance companies may defend you on this. Right? In fact, one of the defense methods is to offer a settlement to pay this person so they just go away. Right? But in either case, if an insurance company has to hire a legal team to defend you or offer a settlement where this person takes and disappears, that costs money. And where's that money come from? That comes from all of us paying higher premiums. So legal hazards, those people that are going for more money than they're legally entitled to, we're all paying for it. And that's how you need to understand that. Okay? All right. Loss. You got to know the difference between direct loss and indirect loss. Direct loss is direct loss, damage, or destruction to your property. So your house has a fire. 1/4 of the house blows out because of explosion and fire, and you can't live there. Well, the fire and explosion is a direct loss, direct physical loss, damage, or destruction to your property. The indirect loss is, well, since you can't live there, the insurance company is going to cover the cost to put you up at a hotel till they rebuild your house so you can eventually move back in. So that was indirect or consequential. Right? So direct loss is direct damage to your property, and because of this direct loss, now we have this indirect expense, and that's what the consequential loss is about. Likewise, if a restaurant has a fire, that's a direct loss, but because they're closed, they're not selling food for revenue. And so business income and extra expense coverage is a type of indirect or consequential loss coverage that you can get as a business owner. But make sure you understand the difference between the two. Aggregate limit, you will get a question on this. An aggregate limit is defined as the maximum that your policy will pay for all claims during a policy period. So let's say you bought a homeowner's policy and you bought $100,000 of liability. That's per occurrence. An aggregate limit would probably be $200,000. That means your homeowner's policy will pay no more than $100,000 per any one loss, but we won't pay more than a maximum of $200,000 during this policy period of 1 year. So you can have a bunch of small losses like $60,000, $50,000, $30,000, $40,000. But once you exceed $2 million during that policy period, the insurance company won't pay anymore. All right, so that's an aggregate limit, the maximum we pay for all claims during a policy period. Sublimit is a limit on a certain type of loss within the overall policy maximum. So remember I said the maximum your homeowner's policy will pay for theft of jewelry is $1,500? That's a sublimit. So even though you may have like $80,000 of personal property coverage, if someone breaks in and steals all your jewelry, you're only going to get $1,500. So it's a limit on a certain type of loss within the overall policy maximum. That's called a sublimit. Now, in the property and casualty world, it's called a sublimit. For those of you that are in other states that are also doing your disability insurance, we call that an inside limit. And so you have a major medical policy with a maximum lifetime benefit amount of, let's say, $6 million. And we're only going to let you use $10,000 towards chiropractic care. So again, it's like a limit on a certain type of loss within the overall policy maximum. Again, for property and casualty, it's a sublimit. For health insurance, it's called an inside limit. Liberalization. You're going to get a question on this. This is also very common. This is where we, the insurance company, had made a bit of a profit and we want to reward our policyholders. So we're going to send you a notice. It's an advance notice. Right? For homeowners, it's a 60-day advance notice that we're going to raise the coverage on your policy and there's no additional charge to you. So liberalization means to liberalize or expand the coverage on your policy for no additional charge. They do have to give you advance written notice. Okay. But that's kind of cool. People think, wow, that's great. Most of you, this happens more than you can imagine. But usually when you get a letter from the insurance company that says this is not a bill, you don't open it. Well, it could be one of these letters where you're getting notified that we're going to increase your coverage limits on your policy. And fear not, there's nothing you need to do, and there's no additional premium for that coverage. Right. Subrogation. This is defined as transferring the claim rights of a loss from one party to another. And so you have a house, you have a homeowner's policy, and someone without insurance loses control and drives through your living room. Now, they don't have insurance, and you can sue them and you're going to win because their car's parked in your living room. But they don't have insurance and they don't have anything to sue for. So then there's no money to rebuild your living room. But you have a homeowner's policy. And one of the perils that's covered in your homeowner's policy is a peril called vehicles, where a vehicle damaged your house. So you pay your deductible. Your insurance company covers the cost to rebuild your house because of that loss. And then your insurance company takes over the claim and goes after that uninsured motorist to collect what they paid you. So basically, the insurance company pays you what you're legally entitled to, and then they deal with that uninsured motorist and collect, what they advanced you plus, legal fees and interest and everything else. Right? That's subrogation, transferring your claim rights. You may get a one-word definition for subrogation would be which of the following, and the answer would be substitution. Right? We're substituting by having the insurance company pay you and dealing with the claim on your behalf to where you can go on about your life. If you suffer a loss and you and the insurance company can't quite agree on what should be paid, well, there's either an appraisal or an arbitration condition built into your contract. So as an insured, as a client, right? Again, you suffer loss and you and the insurance company cannot agree. If it is a property loss, you can go to appraisal. So this is a condition in your contract, right? That if you suffer a property loss and the insurance company says, we're only going to pay you this, and you think, well, wait, no, it should be worth this because I just got it. And there's this dispute, well, then you can go to appraisal. And how that works is you pick an appraiser, the insurance company picks an appraiser. These two appraisers pick an umpire that hears both sides and makes a decision. Okay? Now, that's for property. For liability disputes, we go a different route. That's arbitration. You pick an arbitrator, the insurance company picks an arbitrator. These two arbitrators pick a third arbitrator that hears both sides and makes a decision. If you do go through appraisal or arbitration, the decision will be final, okay? So it's binding. We call that binding, where once they make a decision, like you go to Judge Judy, you plead your case, whatever the response is, you have to deal with it. You can't take it anywhere else. You're deciding to resolve it this way, right? But know the difference. Appraisal is for property losses, and there's an umpire that makes the ultimate decision. Arbitration is for liability disputes where a third arbitrator makes the decision. As far as transacting insurance, know the components. I use SNET, SNET. Solicitation, that's advertising, marketing, trying to get the clients to meet with you. Negotiation is you're having conversations with a client, encouraging them to buy, maybe educating them about the coverages. Execution of a contract of insurance means they purchase the policy. They're filling out the application, they pay the premium, it's underwritten, issued, and delivered. And then the fourth item here, transaction of matters subsequent to execution. That means after the policy has been purchased, right? Maybe you're doing some adjustments to the policy, adding a driver, changing the vehicles, increasing limits. You're basically working with the policy after it's on the books. You can't do any one of those unless you have a license. Right? Please understand that transacting insurance is getting the policy on the books and keeping it there. It has nothing to do with the compensation that you make from a sale. So your question may say, which of the following is not part of transacting insurance? And like taking your wife to the Bahamas from the commissions and agents earned from a sale of a policy. That's not transacting. Transacting deals with the public and getting the policy on the books, not the compensation. If you are transacting without a license and you do get caught, it's a misdemeanor. So end up to 1 year in jail sometimes. So be wary of that. That's real simple. Don't do that. In some cases, you'll see misdemeanor and a $10,000 fine. That's probably more common than the 1 year in jail. Okay, because if it's consistent, then the jail time could come into play. But most cases, misdemeanor and a fine. Right? So again, don't transact without a license. Right? Parts of a contract. Now I'm talking contracts in general. So consideration. In order to have a contract, you got to have these four elements. Right? Consideration is an exchange of value. Clients provide two things of value. Number one, personal information. Okay. Number two, money. Because they have to pay for the policy. So information and paying premium, right, is what the customer gives. Now the insurance company has to give something of value back. Then they're going to give a promise. We promise to pay should you suffer loss according to the terms of our contract. So it's the act of filling out the application, paying the premium for the promise of receiving benefits. That's what consideration is. That's our exchange of value. For a contract to be eligible, I guess you'd have to have legal purpose, or sometimes a test will say legal objectives. Well, the purpose of insurance is to protect against a loss. And that's what you're taught. But your test is going to rephrase that to, instead of legal purpose, they'll say legal objectives, and that means you cannot get a gain. Well, protecting against a loss is the same as you cannot get a gain. It's just covering the loss only. So the test is tricky because they just kind of reword things where it's, you don't quite recognize it. You know, you're studying one thing, you know, this is a blue pen, this is a blue pen, this is a blue pen, this is a blue pen. In all of your licensing training, this is a blue pen, this is a blue pen. Then you go take the test and it says, this is not a green car. Okay, where's the blue pen? You know, because you're looking for this is a blue pen. But this is a blue pen and this is not a green car because it's a blue pen is two ways of saying the same thing. And that's what trips up a lot of people on this exam. The test is passable, but be open to that. A lot of my questions are almost exact to what you'll see on the test, but again, they change questions all the time. They rephrase them. So make sure you get the concepts down. All right, so legal purpose or legal objectives means to protect against a loss. Agreement. In order to have a contract, we have to have agreement. So this is offer and acceptance. Now, as an agent, you are working on behalf of an insurance company and you're offering to sell this person a policy. So you're offering them to purchase coverage. And if they agree with you, then they accept your offer. Then they provide information on the application and pay the first premium, and then they give that back to you. And what they're doing now is a counteroffer. Here's the information you requested. Can you insure me at what you put in your proposal? And so the insurance company accepts this counteroffer, and then they underwrite it, and then they might say, we can accept it, but we're going to have to charge you a higher premium because of this previous claim. Do you still want the coverage? So here comes another counteroffer going back to the client. And this is where they can accept it or reject it. But if they do accept it, then they pay the slightly higher premium. Or, you know, maybe they pay the same premium, but the coverage is less, whatever it may be, and they accept it. So it really doesn't matter who makes the offer. Both parties have to agree to the conditions stated in the contract. That's when we have agreement, right? So that's offer and acceptance. And for a legal contract, you got to deal with competent parties. That's people in their right mind, right? So they cannot be a minor. They cannot be under the influence of alcohol or drugs because they're judgment impaired, cannot be deceased. They have to be mentally competent, not mentally incompetent. So watch the language on that when you take the test. Right? Your companies trust you in hiring you to get licensed and dealing with the public. And so if you come across someone who just doesn't seem like they're all there, maybe you should bow out of that sale because it might backfire on you. Right? Use your best judgment. Now, we're not looking for reasons not to write insurance on people, but I mean, here and there, some of them, it'll stand out where you probably shouldn't. Okay. All right. So that was parts of a contract. Now we have to look at parts of a policy. And for parts of a policy, we have four parts. We have the declaration page, which is the first page of the policy. Now, in the life and health world, instead of calling it a dec page or declaration page, it's called a title page or policy face. So kind of same thing, just a different name. And it's the first page of the policy. It's going to tell you the name of the company, the beginning date and ending date of coverage, right? And a little bit about the coverage limits on the policy. Now, the insuring clause is usually part of that declaration page, right? And the insuring clause tells you this is what type of policy this is, right? That, the insuring clause will tell you purchased a business owner policy. Or the insuring clause will tell you that you purchased a personal auto policy. So it just describes the type of policy. Now, you might see insuring clause or you might see insuring agreement. It's the same thing. Right? The conditions clause, or again, you might see conditions agreement, spells out the duties and rights of both parties. Right? Clients are obligated to fill out the application and pay the premium. If they suffer loss, they're obligated to provide notice of loss and then proof of loss, and the insurance company is obligated to pay the claim. And so the conditions clause, where a lot of your training says it spells out the duties and rights of both parties, another way of saying that is a conditions clause or conditions agreement spells out the obligations of each party, right? That you're obligated to do something to collect from the policy. Exclusion section, that's real simple. This is what the policy will not cover. And when you hear will not cover, think of the catastrophic stuff, nuclear risk, war or active war, earthquake, flood. Those are common exclusions. Wear and tear and intentional acts are not covered by insurance also. So those are like the common exclusions. So on this test, keep that in mind. Now, there's some of them you can buy back, like earthquake and flood, but in general, your policies don't cover catastrophic losses. Those are the four parts of a policy. There are two other areas that you might get that are part of a policy, but not the main four that you're going to be tested on. One of them is the definition section. And so as much as you can Google terms and get a general definition of what it is, you want to read the definition section of the policy, because this is going to tell you what the intent of the policy means by, bodily injury, what that really means versus personal injury, right? They're different. Bodily injury is physical injury to an individual. Personal injury is more of a mental strain, pain and suffering, mental anguish, maybe from a bodily injury or property damage loss, but it's more of a mental thing. You're losing sleep, that type of thing. And so the definition section helps define what they mean by that. And then you have endorsements. In the property and casualty world, they're called endorsements, additional charge for additional features and benefits. In the life and health world, we call those riders. Okay. Again, additional charge for additional features and benefits. They're kind of neat. They're little add-ons that you can, buy and add to the policy to help personalize it to meet your needs. Right? Excuse me. This is kind of a summary. You got to know the difference, parts of a contract versus parts of a policy. Now, you notice that the conditions clause is in parts of a policy. We don't have a condition section in parts of a contract, so don't mix that up. Which is going to throw you, because when you take the test, it'll ask you a question like, all of the following are elements necessary for the formation of a valid contract, except. And you'll have like consideration, legal purpose, conditions, and competent parties. And you're like, what the? Or no, they'll have legal objectives. All right. So, and you're like, what the legal objectives? I was told it was legal purpose. So that's probably the one that doesn't belong. And you would be wrong. Conditions doesn't belong. See, conditions is over here. It's part of a policy, but it's not an element as part of a contract. In fact, conditions is kind of built into the agreement. Didn't we agree to conditions? And so it's not an element to a contract. It's embedded in the agreement element portion of a contract. All right. So contracts, in a sense, we don't have conditions. but parts of a policy we do have a condition section. All right. A fiduciary account. When people pay premium, right, whether they pay cash or check or what have you, you're going to typically deposit into a fiduciary account. This is a non-interest-bearing checking account, typically in the state that you're working in. Non-interest-bearing, because customers' money goes into this account. If you earn interest on customers' money, you're not entitled to it. You actually have to pay it back to that customer because you're earning interest on their money. And so rather than send a 2-cent check to someone because you earn interest on their premium while it was sitting in your fiduciary account, non-interest bearing is a lot easier for accounting. Dollar in, dollar out. So much easier. Now, when a customer pays you premium, no commingling, no embezzling of funds. Now, commingling is you just take the money for personal use, right, because you have an immediate need, and then you pay it back later. All right? Don't do that. Embezzling is you take the client money for personal use and you don't pay it back later. All right? Yeah, you put it in your pocket, do whatever, put a down payment on a new home. And if you're caught commingling or embezzling, you will be found guilty of theft. All right? Remember that. Commingling or embezzling, you'll be found guilty of theft. Don't pick fraud, because we don't know that it's fraud. The only time you really want to pick fraud as an answer is when you see the words intentional or willfully, trying to take something of value from another party. So there has to be intent, all right? If there's no intent, then it's just theft. All right, so you take premium, you put in an account, you process the application, the insurance company sweeps the account, takes the premium money, and basically puts the policy on the books. Now, if a client chooses to cancel the policy, if the refund is coming directly from the company, the insurance company has to refund the money within 25 days of getting the notice of cancellation. But you're the agent of record. This is your client. And so if your customer cancels out, your insurance company may actually give you, the agent of record, that client's premium refund. Once you get this client's money, you need to pay it back to that client within 15 days of you receiving it from the company, okay? Now, but there's another thing you can actually do with that client's refund. You can apply, as long as you let the client know, hey, I have your premium refund from your home policy. Since you already have an auto policy with me, why don't I take the premium refund and apply it towards your auto policy, okay? And you can do that as long as the client is so informed. Right? So otherwise, if not, you can't put that premium towards another client. It's for that client only. It's that client's premium refund. So that's how you want to understand that. So if refunds are directly from the company, they have to refund it within 25 days. But if the refunds are from the agent of record, you need to refund it within 15 days. Right? Now, this last bullet is going to be a little confusing. Because in most cases we really don't deal with this, but it is an older test question that they still keep around. A producer, and by the way, a producer is anyone who's licensed to sell insurance to the public. Okay, that's what a producer is. A producer may retain income commission in a trust account to advance premiums. And so what's happening here is you have this checking account. You have a customer that you sell a policy to on the first of the month. You have an agreement with an insurance company that will just say you get to keep 20%. So the customer, let's just pays $100 at the beginning of the month, 80% or $80 you send to the insurance company, $20 sits in this account until the end of the month when you pay your agent their commission. So that $20 is sitting in a non-interest bearing checking account for 30 days. That's kind of a waste of money sitting on a shelf, okay? And so some other prospect comes along and says, well, I'd like to buy a policy from you, but I don't get paid till Friday. Well, it's only Monday right now, right? And so you say, well, not a problem. And so you take this income commission that's sitting in this account and you apply it towards another policy for this other insured, because you're trusting them to pay you the premium by Friday, which is before the end of the month, to pay your agent their commission. That's kind of what they're talking about. Now, in the real world, that's typically not how you're going to operate. But for the exam world, that's acceptable. All right, so just look out for that question. A producer may retain income commission in a trust account to advance premiums. That's a true statement. But watch out, because every once in a while they'll put the not. A producer may not retain income commission in a trust account to advance premiums. That would be a false statement. Okay, so be wary of that. And there's a couple of questions that I have on my site that you may not understand, but just know when you see this question, look for this answer. And this is kind of like one of them. I mean, I understand what's behind it, but sometimes it's a little difficult to explain. Okay. Some other definitions you do need to be aware of. Adhesion. Now, think of adhesion as an adhesive tape. We, the insurance company, print up the insurance contract. It's in our language, right? And if our language is unclear, you have a loss, and it's uncertain whether or not coverage really applies here, the customer is going to win. It's the insurance company's fault for not clarifying the coverage in the contract. Right? So again, they're stuck to their terminology and they have to pay out on a claim because it's their fault. Now, every once in a while on the test, you'll see adhesion as a take it or leave it contract. Since it's in the insurance company's language, you as an insured, you can either take it and accept it or say, no, I don't want it, and you can shop somewhere else. So there's two definitions for adhesion. Number one, it's a take it or leave it contract. But number two, if the contract is unclear, and the key word you might see is ambiguous, general, or vague, right, the courts will determine in favor of the insured, the client. Right? So if the policy is unclear, the courts will basically take the customer's side on a loss. It's the insurance company's fault for not being clear in the intent. All right? Now, alliatory or alliatoric. Again, you're learning a lot of definitions for the test, but when you get in the real world, you're not going to use them with your prospects, your clients. Okay? It's just to learn it for the test. But you'll understand the concept. Now, alliatory, one of the again, here's another two definition thing. Alliatory means performance depends on an uncertain future event, which kind of ties into insurance. In order to insure it, the loss must be uncertain, right? That would be alliatory, where the loss must be uncertain or based on an uncertain future event. That's one definition. The other definition is unequal distribution. Another way of saying that is you may get more or less than what you paid for in a contract. All right. So, someone's at an auto dealership. They're buying auto insurance to get the insurance to get the car off the lot. They pay 1 month's premium. And as an agent, right, you gather information on the application. You take the 1 month's premium. You offer a binder, which is a receipt for that payment. Binder in possession. They hop in their new car. They drive off the lot and just drive right into a truck. They didn't look when they just jumped out into the street with that car. Now, they paid 1 month's premium. And since you bound the coverage, they get the equivalent to a replacement vehicle. So they got more than what they paid for. They paid $100 and got the value of a replacement car. Now, that may bother you, the agent, but it doesn't bother the insurance company. Because even though this person paid one premium and got a total loss payout, we have thousands of policyholders that'll pay auto premiums the rest of their lives, and a lot of them will never, ever file a claim. And so they got less than what they paid for in an insurance contract. That's how you want to understand alliatory when I say unequal distribution, or you may get more or less than what you paid for. Okay. Bilateral. Most contracts are bilateral. Bilateral means promise for promise. Hey, I promise to give you a piece of beer if you promise to help me move this weekend. Now, you can shake on that because that doesn't have to be in writing. Either one of you can cancel out any time. Hey, I decided not to move this weekend. I'm going to move next weekend. or your friends might bail on you. They don't want to help you move. And so either one can cancel out at any time. Insurance is typically unilateral. Once we, the company, issue the policy, you can cancel out anytime you want. But the insurance company has to have a legitimate reason to cancel out. So it's kind of one-sided. You're going to get unilateral more so on the life and health exam, but you may get that on this exam, right? That is one-sided. I mean, just look at the name. Uni meaning one, lateral meaning sided. Right? So it's a one-sided contract. The next item, insurance, is a personal contract. A personal contract means it's a two-party contract. The two parties are, well, the first party to a contract is the insured, the client. The second party to a contract is the insurance company, the insurer. You can't get much more personal than that, right? So two parties. Anyone other than the insured and the insurer is a third party. But it's not a three-party contract like a bond. Bonds are three-party contracts. Insurance is two-party contracts. Okay? And insurance is insurance. Bonds are financial guarantees. So it's a little different. Utmost good faith. When you sit with someone, you're going to ask them questions on the application, and they're going to answer you with a representation. To my best knowledge and belief, I don't think I've had any tickets or accidents in the past 3 years. And you're going to trust them. So they answer your question with a representation. To their best knowledge and belief, this is what they're saying is to be true. Okay. Now, likewise, they may ask you, so how does this coverage work? And you're going to explain it to them. Now, this customer is trusting that what you're saying is true and correct to the best of their knowledge, or the best of your knowledge, right? And so each party to a contract makes representations. That means each party trusts each other. I trust you, you trust me. If we didn't trust each other, then you wouldn't buy a policy from me, and I wouldn't want to sell you one if it may backfire. You see what I mean? And so I trust you, you trust me, is just a general way of doing business. But on your test, it doesn't keep it that simple. Right? Utmost good faith really means I trust you, you trust me. But on the test, utmost good faith is usually stated or defined as, we're going to rely on the representations of either party without any attempts to conceal or deceive. I mean, they just go crazy with the terminology. That's the exam way of saying, I trust you, you trust me. All right? So you got to be ready for that and look out for that. All right? Waiver. Waiver is a voluntary, intentional giving up of a known right. Okay, so where I bring this into play is years ago we had Desert Storm, and we had a couple Americans die during Desert Storm. The insurance companies at that time for life insurance actually had a military restriction, which actually they excluded losses due to military action. So if you were in the military and you died in a war zone, right, or fighting for the country, the insurance companies would actually exclude and not pay a death benefit to your beneficiary. Well, during Desert Storm, the insurance companies lifted the military restriction and actually paid to Americans that died during Desert Storm. So the waiver is they gave up the right to deny coverage for military action. That's the waiver. They gave up the right. They actually paid. Now, because they did that, they set precedents. That means even though Desert Storm has ended, they can't say, okay, so now the war's over. We're not going to pay for military action anymore. No. They set precedents. So they now have to honor that in case there's any other military action and military personnel die. And so that's the legal doctrine of estoppel. So waiver is you give up a right. Estoppel says once you give it up, you don't get it back. So from here on out, if someone has one of these policies and they die while engaging in military action, this policy has to pay the beneficiary. Right? So estoppel is not that common. It does pop up on the exam. Waiver is the one that's more common. Okay, waiving the right to deny coverage for whatever reason. Okay, so again, waiver is giving up a right, whether it's voluntary or intentional. right? And estoppel says once you give it up, you can't get it back. Okay. Domicile of an insurance company, and also being admitted or not admitted or approved. So domicile just means, where did your company originate? Where did they first, set up their shop and get approved as a business? So if they set up in your state, that's a domestic insurer. If the insurance company originated outside of your state, that would be a foreign insurer. And if the insurance company originated outside the jurisdiction of the United States, that would be an alien insurer. All right. So pretty much every insurance company falls under those three headings, right? Either they incorporated in your state, or they organized outside the state, or they originated outside the country. All right. That's how you want to understand that. So that just means, where is your company from? Now, it doesn't matter where your company's from. Did they get approval to transact or sell insurance in your state? Did they apply and pay fees to get a certificate of authority to be approved to openly, actively sell in your state? And if they did, then they would be admitted. If they didn't, they would be not admitted. Now, not admitted doesn't mean they're a bad company that couldn't comply. Maybe they just didn't care to. Maybe you set up a company here in California, but you want to do all your selling in Oregon, right? So here I'm in California, you would be domestic because you originated in my state, but you're not admitted because you didn't get approval to sell in my state. But if you were an Oregon resident, this company would be foreign because that company originated in California, not in your state in Oregon, but it would be admitted to do business in Oregon. You see? So domestic, foreign, alien just means, where did your company originate from? And admitted or not admitted means, did they or did they not get approval to sell in your state? They're two different topics, and make sure you keep them separate. Now, on the exam, they want to blend it to kind of throw a kink in the system. And they'll say something like, a foreign insurer is an insurance company that originated outside the state and must be admitted. Okay, a foreign insurer, yeah, that's outside the state, but must be admitted? No, that'd be a false statement, because you could be foreign and not admitted. You see? So you have to watch out for things like that. So, yeah, domestic insurer is one that originated in your state, whether or not admitted to do business in your state. An alien insurer is an insurance company that organized or incorporated outside the jurisdiction of the United States, whether or not admitted to do business in your state. So again, if this says must be admitted or must be not admitted, those are kind of some false statements to watch out for. All right. So yeah, the test is tricky. I mean, it's tough learning insurance because it's like a whole new language. But then when you take the test, they throw you these curveballs with they're going crazy with the thesaurus and changing up the terminology. But again, be consistent in your studies. It's doable. So if you haven't registered, jump in, go to lgdstudy.com, right? Choose the course. You get things like this webinar. You get sample test questions. I've got charts to help you understand the different coverages. There's more recorded webinars, and there's the online playbook. So those of you that are going through the sample test questions on my site, make sure you also go through the playbook. Realistically, I think that's one of the best tools outside of some of the charts I have to help you understand word association. It's kind of like a flashcard set. When you see, Paul versus Virginia, know that insurance is regulated at the state level. The McCarran-Ferguson Act insurance is primarily regulated at the state level. Okay, but there is some federal and self-regulation associated with that also. So it kind of helps give you some word association to help you out. Okay, and so with that, I'm going to pause here and open it up to, do you have any questions? No? Okay. Well, if you have any questions, do not hesitate. Reach out, give me a holler. And with that, I'll say thank you very much for joining me in the webinar. Have a good evening and good luck in your studying.